Hi, everyone. Thanks for joining us. We'll go ahead and just give it a minute here to let others hop on, and then we'll get started at the top of the hour. All right, I see people still joining, but we'll go ahead and just dive right in. Thank you, everyone, for joining us today for the first of the Financial Foundation Summer Series, Investment 101. My name is Emily Platt. I'm the Vice President of Advisor Success here at WealthSpire Advisors. I'll be moderating today's session and will help guide us through Q&A at the end. We have both clients and non-clients joining us today, so I want to give a quick introduction to WealthSpire. We are an independent fiduciary wealth management firm with over 20 offices nationwide, managing more than $30 billion in assets. We work primarily with high and ultra high net worth individuals and families, offering personalized planning, investment management, and guidance across generations. Really, at our core, we're a learning organization. We're committed not just to managing wealth, but to empowering our clients through education and meaningful long-term relationships. And that's why really we've created the Financial Foundation Summer Series. It's to provide clear, actionable education on essential financial concepts. So this series is designed to build confidence, spark conversations, and really lay the groundwork for lifelong financial understanding. A few administrative items before we jump in, just to note that today's session is being recorded, and we'll be sending the recording and registration links to the rest of the series in the follow-up email to everyone who registered. And also the Q&A box is open, so feel free to drop in questions at any time during the presentation. We'll address all questions at the end of the session. We're excited to be joined today for Investments 101 by three members of the WealthSpire investment team. We have Chris Maxey, Chief Market Strategist, Connor Darrell, Vice President of Investments, and Michaela Johnson, Associate of Investments. So with that, I'll go ahead and turn it over to the team to get started.
All right. Thank you, Emily. Fantastic introduction. We appreciate everybody taking the time to join us. And as Emily mentioned, this is the type of content that we really love having conversations around, that opportunity to educate, be an organization focused on lifelong learning and being able to share the things that we've learned, the lessons that we've learned, and the ways that we're applying them in working with clients and working with prospects and educating others in the industry. And so we really appreciate everyone taking the time to join us today. As Emily mentioned, we're really happy to have such a wonderful team here at WealthSpire, not only the individuals that you see on this call, but the people that we work with every single day. And the culmination of all of our work is captured throughout the course of the presentation today, but we recognize that there might be concepts that are still a little bit unclear and things that you want to know more about. So this is where we always encourage people to reach out to us, to engage with us, to send in their questions, and really appreciate, again, all of your participation. So why don't we go ahead and start moving into our conversation today? I do see there are a few things already through the chat, people asking about the sharing of the slides, and we will make sure that those are passed around and shared with everybody. But so as we think about what we want to cover today and the topics that we're going to be going through, it's these 5 items here. So at a very big picture, what are the basics that you need to understand? And for a lot of people, they're just beginning their investment journey. This is something that perhaps they've started to think about. They've wanted to engage with how they build an investment portfolio. What are the reasons they would want to do that? And how do they go about it? So we'll go through the basics. We'll talk about what the asset classes are that you need to know. And you can see that numbers 3 and 4 there are the stock and bond market. And then we'll go back through the core concepts. So this is really the first part of a multi-series conversation that we're going to be having over the summer. And you know, there will be a lot of information shared here, but we're going to continue to build on this as we go out through throughout the summer months. So we would encourage you to join us in those other conversations as well. What I'm going to do now is hand over to Michaela Johnson on our team. She's going to begin that component of walking through the basics of investments and why we really go about this. So, Michaela, why don't I hand over to you? You can share with us, the basics of what this is all about.
Yeah, thanks, Chris. All right, guys, let's kick things off today by just starting with a basic question. Why do we invest? What's the point? And it really comes down to three reasons why we invest our money. First, we invest to preserve purchasing power. Purchasing power is your cash losing value over time due to inflation, and investing helps us keep pace with rising costs so our money doesn't fall behind. Second, we invest to grow our money over time. So the earlier we start investing, the more time our money has to benefit from compounding, which is earning returns on top of returns. And third, we invest to create financial freedom and flexibility. So investing gives you choices. That is when to work, where to live, how to spend your time. And investing is the tool that really helps you build the life that you want. And these are really the three principles that form the foundation for our discussion today. And so let's dive deeper into each one of these. Starting with inflation here. So inflation is complicated, and I think the best way to understand how inflation works is to see it in action. So this is a sample grocery basket, 7 basic items. You walk into a grocery store, you get your milk, eggs, bread, ground beef, chicken, bananas, oranges, the works. And in 2015, that basket would have cost you about $14.20. Now, fast forward to 2023, that same basket now costs you $20.95. So that's a $6.75 difference, and a more difference than it was in 2015. And so that price jump shows how inflation erodes the value of cash over time. So holding on to your money and cash alone won't keep pace with the cost of living adjustments. And now we think about how a longer life complicates this picture. And this chart here shows life expectancy at birth in the US going back to the 1960s. And the trend is pretty clear. People are living longer, which is a good thing. That means we're healthier, we have a better quality of life, but it also complicates life from a financial planning perspective, because it means our money needs to last us longer, especially in retirement. So longer lifespans means more years without a paycheck and more time that your portfolio needs to support your lifestyle. And this is another reason why investing early and consistently is so important, because we need more resources later in life to maintain that same quality of living. And this really leads us into one of the most important investing principles, and that's the time value of money. And the time value of money is the idea that a dollar today is worth more than a dollar in the future. And that's because money you have now can be invested and has the potential to grow over time. And so what this chart is demonstrating is the impact of starting age on a consistent investment. So $500 a month at a 7% growth rate. Let's say you start investing at age 20. Well, at age 65, you're ready to retire. Your account value would be close to $900,000. Now, if I was to just start 5 years later at age 25, my account value at 65 drops off by about $300,000. And so the message here is the longer you wait to invest, the larger that drop off gets. And if you start at age 40, we're talking about account value around $160,000. So this is really the power of compounding in action. The earlier you start, the more time your money has to grow. Now let's look at compounding over a longer time horizon. So this chart here shows us how $100 would have grown over about a 100-year time frame if it was invested in US bonds, which is demonstrated in blue, and then US stocks demonstrated in orange. And what you can see is that since 1926, bonds returned about 4.9% annually, while stocks have averaged closer to 10%. And in the first 20 years or so, the difference in growth between stocks and bonds is pretty small, with some years bonds even growing more than stocks. But if you zoom out past that 20-year time horizon, what you can see is that gap gets significantly wider. And with $100 in stocks growing to above $1 million today, and in bonds growing to just over $10,000. And that's really, again, the power of compounding, higher returns accumulating over time. And it's not just about starting early, but also staying invested in the long haul to allow that growth to multiply. And I think a good rule of thumb for any investors is the rule of 72. It's just quick math for compounding. And the rule of 72 is the number of years it takes to double your money at an annual given rate of return. So 72 divided by a rate of return gives you the number of years it takes to double your money. So at a 2% annual return, you're talking about 36 years to double your money. Now, if we increase that annual return to 6%, we're talking about 12 years to double your money. That's a significant difference there. And as we just saw on the last page, US stocks returned an average of 10% annually over the last 100 years. So if we take that same rate and apply it here, your money would be doubling around every 7 years or so. And so that, and you take that over many decades, that adds up to a lot of doubling, and it just highlights how important it is for time to be on your side when it comes to growing your wealth. So this goes back to our original question. Why do we invest? Well, plain and simple, investing helps our wealth grow over time. And when it comes to, it helps us keep up with inflation. It helps us take advantage of compounding. And really, it's working towards greater financial freedom. And I like to say with any good recipe, long-term financial success really depends on the right ingredients and the right process. So it's important to start with time because you need time in the market. It's the greatest advantage for investing. Add in consistency. So even small contributions to your investment account add up over time. Let it sit. Time in the market is better than timing the market or trying to get in and out. Give yourself time to invest and let your growth compound on one another and be patient, finally, at the end. So next, we're going to dive into key asset classes. I'm going to turn it over to Connor to speak further about that.
Thanks, Michaela. So thus far, this conversation has been focused on the why behind all of this, right? But now we're going to start to transition into the how. But I think any fundamental kind of introductory conversation about investing needs to start with the building blocks. And to us, that means first defining what we call the opportunity set, or the list of available investments that we need to choose from. And if we go back to that food or recipe theme that we had on the previous slide, that essentially translates to our menu of investment options. And so we will touch on this in a little more detail later, but that opportunity set is massive. There are literally thousands of different investments that we can conceivably put into a portfolio. But to help us make sense of all of that, we need to first break things down into simple categories of investments. And these different categories are likely to play different roles within a portfolio when we kind of think about building a portfolio from the ground up. But to keep things simple to start, we want to put them into 4 major categories, and you'll hear these referred to as asset classes. And those are going to be stocks, bonds, cash, and alternatives. And I'll expand on each of these categories individually as we move forward here, starting with stocks. So stocks are likely the first asset class that most people think of when they think about investing or getting started with investing. They are the most quoted investments in financial news media and are often used as a barometer for how the economy is performing. But it's important to understand what they actually are because that has implications for how they perform over time. So as is written at the top of the slide here, stocks are merely an ownership or an equity stake in a company. And when you buy a stock, you become a part owner of that company that the stock represents. And the more stock you own in a company, the larger percentage of the business you own. And so when you invest in a stock, you're doing so because you believe that the value of that business will increase over time, right? As a part owner of that business, you're participating in all of the future growth that that company may generate. And that also affords you the privilege of voting on how the company should be run. So those are called proxy votes, and there's many of them that may take place over the years, but typically there's a board of directors that's more involved in running the business, and then they might hire an executive management team, a CEO, a chief financial officer, etc. And you as a shareholder have a say in who gets to be on the board of directors, as well as voting on a variety of other businesses, of the businesses related decisions. And that those things may be put up for shareholder approval over time. And companies issue stock primarily as a means of financing an expansion of the business, or perhaps to help pay off debt. I think a great example is to think about the show Shark Tank. For anyone who's seen it, right? Somebody comes in, they explain their business to the sharks, and that gives them an opportunity to purchase a stake in the business in exchange for providing some cash to either help them continue to grow, add inventory, whatever that might be. So with stock investing, it's the same process, just on a much larger scale and with a much more fragmented ownership model. But there are also other ways of providing cash to a business that might be in search of capital, and one of those is through the bond market. So whereas with stocks, you're taking direct ownership in a business. With bonds, you're making a loan. Or in other words, you're becoming a creditor of the business. And a business may issue bonds for the same reasons that it might issue stock. Maybe they need financing to fund an expansion or to build a new manufacturing plant, but perhaps the existing ownership would prefer to retain the same proportion of control over business decision making, or perhaps interest rates are low enough that they feel it's just simply a better option to borrow money. So they may choose to issue bonds instead of stock. And as an investor, bonds tend to be safer than stocks because as a bond investor, you're entitled to recourse should the business go bankrupt. And that's sort of the primary difference between stocks and bonds in terms of how they fit into a portfolio. And we'll dive into that a little bit later. But they have different levels of risk associated with them, and thereby different levels of expected return over time. And the last thing I'll mention here is that just in a practical sense, the functionality of a bond from a business perspective is really quite similar to going out and getting a loan from a bank. But the structure of that loan is slightly different. And we'll talk through some of those specific mechanics later, but I'll leave things there for now. But just to drive home those concepts a little bit better, we're going to talk through a brief case study here using our friend John, who is interested in opening up a lemonade stand. So apparently John has not been very diligent with his savings because he doesn't have enough money in his bank to purchase everything he needs to start this business, which based on the supplies in the image, I'd say is probably no more than $200. But in any case, John needs to go and find some investors to help him get started. And he has a choice, right? Option one is to issue stock. Option two, issue bonds. So with option one, John sells shares of the stock to investors who supply him with the cash he needs to go out and buy the wood to build his stand, and then all the inputs he might need to make lemonade. So who knows, he may even ambitiously start building a vertically integrated business, purchasing some lemon trees and really starting to own the market. But those investors are now part owners in his lemonade stand, and so he has to share in any success that the company has going forward. For investors, that's great, because they technically have unlimited upside potential. Maybe John's idea proves to be so great, it becomes a global business selling lemonade all over the world. But the downside there is that if John falls flat on his face and the business goes belly up, those investors will lose all of their money alongside John. So overall, the bottom line is that as an equity investor, you have more of that boom or bust potential depending upon how the business performs. Whereas with option two, John can issue bonds, help him raise the money he needs in the same way. He might prefer this because he gets to retain all of the equity in his business and then retain full control over how it operates, retain full control over keeping the profits from the business. But the downside from his perspective is that he has to pay a fixed interest rate to bond investors, which might give him less flexibility in terms of how he can actually reinvest any profits or run the business going forward, because now he has to worry about paying back his debts. For bond investors, they aren't able to participate directly in the growth of the business, and so their upside is capped. But they have better protections in place in the event that John's business fails. Because they're creditors of the business, they can come in and actually take ownership of the business's assets in the event of a bankruptcy, right? Theoretically, those lemons, the lumber from the stand, and maybe those lemon trees if John went that route. They all have some value, and bondholders would have the ability to step in and take some of that should he fail to meet his obligations. And so bond investors, for that reason, are unlikely to see a total loss in the event that there is a bankruptcy. And so from both John's perspective and the investor's perspective, there may be different preferences for issuing or investing in stocks depending upon their unique circumstances. And the primary function of markets, whether that be stock or bond markets, is to help connect investors and businesses so that these sorts of financing activities can actually take place. And that's a foundational component of our economy, right? Connecting investors and businesses so that entrepreneurship can thrive and take place and capital can find a place to help drive business forward. But again, stocks and bonds aren't the only types of investments that exist. Cash can also be an investment, right? If you deposit cash into a bank, the bank will pay you an interest rate. It may not be a lot, but it isn't zero. And there are other types of investments that we characterize alongside cash simply because they're so safe so as to be virtually risk-free. And just from a categorization perspective, it makes it a little bit easier to lump them together. And those are going to be things like money market funds, T-bills, which are short-term bonds issued by the US government, and then CDs or certificates of deposit, which are issued by banks. And again, some of these may technically be constructed more similarly to bonds or literally as bonds in the case of T-bills. But again, we categorize them alongside cash because they are uniquely lacking in risk. And so this category is really your safest. It's the financial market equivalent of burying your money in a hole in the backyard. And there can be a role for that type of asset within a portfolio. In our view, that role is likely to be very small, primarily because there's very little upside associated with it other than that small rate of interest that you're gaining over time. But again, it's not zero. And so we include it in the universe of investable assets. And it may be very appropriate for some people who have a very short time horizon or are saving for something. And then the last category of investments we'll cover today is alternatives. Alternatives is sort of an all-encompassing term that captures basically everything else. So these are going to be things like physical assets, like real estate or commodities. So anything that has value that you could kick with your foot. And you can even throw things like collectibles or art into that category as well. And probably crypto, even though that opens up a whole can of worms that we don't need to get into in this kind of introductory 101 level discussion. But you'll also see things like private investments or hedge funds lumped into the alternatives category. Even if technically some of those are a form of equity or lending, they end up in the alternatives category because of the way that they actually behave in a portfolio. And we can talk about that as we get more advanced. But for all practical purposes, I would think of alternatives as any investment that behaves functionally different from a traditional stock or bond, or that plays a unique role in a portfolio. And that's something we'll likely expand on, as I mentioned, as we move on into perhaps the 201 level session later this summer. And so that concludes our general tour of the different asset classes and their categories. And so what I'm going to do now is to take a deeper dive into both the world of stocks and the world of bonds, because those are far and away the most important asset classes for the novice investor to understand. But first things first. So what you're looking at here is what's known as the capital stack. And the capital stack is simply a way to visualize and describe the different layers of money that are used to finance a business. And they're listed top to bottom here from the safest to the most risky from the perspective of the investor. And so at the top, you'll see senior debt, and those are your bonds that we described earlier. As a bond investor, again, you're lending money to a business, and you essentially have first dibs on any remaining assets on the balance sheet should a bankruptcy take place. But there's also different layers of bonds, often referred to as mezzanine or subordinated debt. Those investors might receive a higher interest rate because they're taking on more risk. And that risk comes into play again because if there's a bankruptcy, they need to wait until the senior debt holders are repaid before they see any recourse. And after that, you start to get into the equity sleeves. Preferred stock is a less common form of equity investing that takes priority over the common stockholders. But for all practical purposes, when we talk about stocks, the vast majority of the time, we are talking about common stock or common equity. And that's what we'll focus on for the next few slides. And we hinted at this before when we talked about kind of the unlimited upside to owning stocks, but it's important to put into perspective why, as an investor, we should own them. And the short answer is that stocks are far and away the most significant driver of long-term investment returns. And Michaela was showing that chart before that I think also helps to illustrate this point. Over time, the economy tends to expand, and as a result, businesses will grow alongside the economy. And that in and of itself is a wealth generating engine. And you can see on the right-hand side here that equities have historically produced returns that a meaningfully higher rate than any other asset class, to the tune of 10.1% over the past 20 years. Michaela's 100-year example was 10.4. So it's really been around that 10% marker for an extended period of time. And if we go back to that rule of 72, that's a good amount of compounding and doubling that can take place if you're invested in stocks over the long term. But because they're lower in the capital stack, stocks are riskier. And that's reflected in a term you'll often hear thrown around in the world of investing, and that's volatility. And that's measured by the variance of returns over time, or the ups and downs of those returns over time. And the most common measure of that variance is standard deviation, which is what's represented by those percentages in the portfolio risk column in the table on the left. And we don't need to get into the actual math, but the key takeaway here is that stocks are far and away the best opportunity for you to maximize your investment returns over time, but they also bring higher levels of risk along with them. And so for many investors, it's important to find that right balance that's based on your circumstances. But when we actually dive into the world of stocks, there are many different ways that stocks themselves can be further broken down into subcategories. And those are often going to be based on things like market capitalization, or in other words, how big the company is. But you'll also see categorizations focused on geography, or the type of market those businesses might operate in. And so you'll see terms like developed or emerging markets, which is a way to classify that marketplace and get a sense of the type of risks that might exist there. The United States or Germany would be examples of developed markets where there's a well-established rule of law, a dynamic and high-functioning economy, and that tends to be lower risk than investing in a company located in an emerging market, such as Mexico, India, or Vietnam, where the rule of law is a little bit less developed. Maybe the economy has a little bit more uncertainty associated with it, and so there's just naturally more risks associated with investing in a company that's based there. So there's a number of other ways that stocks can be further broken down, but those are just kind of a couple high-level examples. But the scope of the global stock market is massive, to the tune of almost $100 trillion of investable stocks that exist today. And that technically doesn't even cover everything. But that's also a lot of opportunity that exists out there to participate in economic growth and participate in the businesses that are generating profits. But one of the most fascinating things about markets is how dynamic they are, and really how representative they are of where the world of business is going. This is a chart that shows you the size of different industries over time, and those sizes are based on the pricing that exists in these living, breathing markets that are constantly valuing stocks and bonds that trade on exchanges. And you can see that these things change over time, and in some cases quite rapidly. Even just looking at the last 30 years or so, if you go back to 2000, it was all about tech hardware, so computers and other equipment. Then it was energy that was the dominant sector for a period of time. Now it's things like software and semiconductors, which are needed for the harnessing of AI, and that's kind of the next off-ramp to innovation. But if you were to go back even further, you'd see periods where railroads, for example, were the biggest businesses. And so the market evolves over time in a way that reflects the broader economy and the direction that it's headed in, which I think is really interesting. And from a practical perspective, it's helpful because you don't necessarily need to make these changes to your portfolio yourselves. Because if you invest in a broadly diversified fund that owns all of these things, these changes will be reflected naturally in your portfolio over time. And you'll be able to tailor your portfolio in a way that captures the evolution of the economy in real time. But those changes can take place very quickly. And as I hinted at, there's volatility associated with investing in the stock market. And that's what we're looking to illustrate here. So stocks price in real time based on supply and demand in the marketplace and based on what's going on in the world. And so there's a lot of noise that can impact prices on a day-to-day basis that can make it stressful if you're watching things in real time. A perfect example of that was during the early stages of the COVID-19 pandemic. So go back to 2020. The global economy was basically being shut down, right? Nobody was allowed to go anywhere. Businesses weren't able to function normally, and nobody had clear visibility into how the economy would be able to move forward in the same sense that it had been. And so markets sold off because of all that uncertainty and lost a lot of value. But the most important fundamental thing we want you all to take away from this discussion, I think, is that as the things that matter in the long run are a lot different from the things that impact prices in the short term. In the long run, it's all about the fundamental success of businesses in the economy. And that's most easily measured by EPS, which stands for earnings per share. Basically, that just means how much profit is the business generating for each share of stock that it has issued. And hopefully it stands out on this chart that the trajectory of the stock market over the long term is closely tied to that EPS number. And so as long as profits are rising, you should expect to see positive returns from your stocks over the long run. Obviously, things can impact sentiment, enthusiasm, markets in the near term, but as long as that economic engine is driving forward, you should see positive returns in your stocks. And that should make intuitive sense when you come back to the basics and kind of just remember that as a stock investor, you are simply a partial owner of the business. And businesses exist to make profits, right? That's their fundamental purpose. And so with that, let's shift over to dive into the bond market before I send it over to Chris to wrap up the discussion and kind of tease out the next session. Similar to what we illustrated with stocks, there are a variety of different ways that we can break down the $80 trillion bond universe down into subcategories. I think the most common categorization that you'll see is based on credit quality, and that's where you'll see the term core bonds. So core bonds are the largest category and are comprised of investment grade or higher rated, safer bonds, and those that might be broken down by geography as well, similar to what we did with stocks. So there's a lot of different ways that you can go through this sequencing. But there's also money market investments, which, as we talked about earlier, are those ultra short term in nature, and they operate more similarly to cash from the perspective of an investor. And then there's high yield bonds, also known as junk bonds, which are bonds issued by companies or governments that might be perceived as more risky or more likely to default on their obligations. And I think a good example of the difference between a core bond and a high yield bond would be to think about a US Treasury bond as compared to a bond issued by a small business engaged in, let's say, exploratory mining, right? The US government essentially has its own printing press. It's never defaulted on a loan in its entire history. And although we do continue to issue more and more debt and things are getting increasingly uncertain, it is still a very safe asset. And the US economy is one of the strongest economies on earth. But that small mining business is riddled with uncertainty. What if they don't find as much resources as they thought when they build their mine, or the construction of the mine itself proves to be more expensive than they anticipated? They are far more likely to default on their payments than the US government is. And so an investment in that bond carries very different risk and should be categorized or thought of differently. And that's what we're trying to capture when we think about these different categorizations of bonds. And then there's some other categorizations that tend to be more risky as well. You've got bank loans, which are loans made by banks to companies that may have a variable interest rate component as opposed to a fixed rate. So there's a little bit of a different feature associated with those bonds. And then you have emerging market bonds, which are bonds issued by companies or governments that are located in those emerging markets that we talked about earlier. Again, this is not an all-encompassing list, but it's designed just to give you a sense of all the different types of bonds that exist in the marketplace and all the different pieces that you have available to you when you're thinking about putting a portfolio together. But for purposes of the rest of this discussion, we're going to focus more on those core bonds, which are the safest investments and really make up the majority of the marketplace. Going back to our lemonade stand example, this is a diagram that sort of traces the life cycle of a bond and how the money actually changes hands, right? So you start with an investor, they loan money to John and his lemonade stand, and in exchange, John uses that money to invest in his business and work towards growing it. In exchange for taking that loan, John also agrees to pay the investors a fixed interest rate at some regular interval of time as agreed upon in the bond's documentation. And I think it's important to stop at that point real quick because there is a contract involved in all of this. John is contractually obligated to make those payments. And if he doesn't, he's technically in default of his agreement, and the investors may be able to come in and start seizing his assets in the same way a bank might seize on your house or your car if you don't make your payments. But assuming that doesn't happen and John continues to make his payments on time, at the end of the bond's term, you'll also see here that the term maturity, John will pay back the full principal of that loan in one fell swoop. So in this case, it's a little different from your mortgage payment or your credit card bill. So just to use hard numbers here, let's pretend the bond was $100,000. The investors, it doesn't have to be just one of them. There could be several who participated in making this loan. They'll lend John a total of $100,000 between them. And John will then make coupon payments back to those investors once or twice a year. Let's pretend for simplicity's sake, it's once per year and there's a 5% rate. So he'll make one $5,000 payment every year for a given amount of time. After that time's up, he owes that $100,000 back to the bondholders. And at that point, he may even elect to issue new bonds to fund that $100,000 payment and keep the cycle rolling. But that's getting into mechanics that are beyond the scope of this discussion. The bottom line is that the life cycle of a bond is very different from a stock, which exists into perpetuity, right? The life cycle of a bond is finite. And so there are very different characteristics when you're thinking about owning bonds versus owning stocks. But just as we asked the question, why would you want to invest in stocks? We can ask the same thing about bonds. And with bonds, the answer is more about the protection and the certainty that they can provide in your portfolio. Because they are higher in the capital stack that we talked about, and because they have very well-defined terms, they are far less volatile than stocks. And in fact, because they have those defined terms that I laid out in the bonds, that are clearly laid out in the bonds contractual terms, a bond investor can actually calculate what his or her return will be over the life of the bond down to the penny, assuming that there isn't a default. And because of that, they don't experience the same type of wild swings that stocks do because there is a more clearly defined value to that cash flow stream. And that makes them a great complement to owning stocks. And that's what we're sort of visualizing here. So the blue bars are the return in the stock market during 5 different recent periods of market stress. And you can see that some of those losses are quite large, to the tune of 50% during the financial crisis back in 2008. And then in yellow, we show the returns on fixed income or bonds. In most cases, that yellow is far safer, or that yellow return is far safer than that of equities. And in some cases, you actually see that bonds produce a positive return in some of those environments. And so bonds can come in handy in those periods and can be an important risk management tool in portfolios. And then just returning to that capital stack visualization from earlier, as I hinted at, the reason that bonds are safer is that they receive higher priority in the event that a business fails. And that sort of by definition makes them safer, which translates to them performing better when the economy is doing poorly. Because you, an investor, are less likely to lose money. It's as simple as that. And so with that, I'll pass things over to Chris. And Chris, you can tie a bow on everything that we covered today and review some of those core concepts.
Thank you, Connor. So I know that we have gone through quite a bit up until this point, and there was a lot of ground that we've touched upon. What we'll try to do now is synthesize all of this into what we think the main takeaways and main points are. So if we take a definition as to what we think investing is, right, we think in terms of horizon. So there are questions about having a long horizon and how older folks can think about investing. Long-term is really a reference to what is your specific horizon. And that long-term could be measured in a couple of years, in which case you're going to think about your stock bond allocation. And perhaps you have more of those conservative assets like Connor was talking about that are focused on bonds. And you have a bit less of the risky asset that is susceptible to the drawdowns in the period of losses that we saw in March of 2020. So less of those stock assets. But it's also balanced. So when we think about investing, depending on somebody's horizon, the balance of assets is tied into how we would think about the most appropriate allocation for them. But it's also tailored, and that's what we've been referencing here. You really have to think and be thoughtful around how much risk am I comfortable with? How much do I want my portfolio to grow? What is my horizon? What can I tolerate? When you think about the things that you should potentially be cautious of, you want to be cautious about what a short-term horizon looks like, meaning that it's difficult to successfully trade in increments of hours, days, and seconds. But you also need to be careful about shiny objects. The Wall Street jargon machine is a very powerful one. And just in the course of this conversation today, we've heard a lot of the jargon. We try to make it accessible and try to define what it is, but there's a lot of jargon in Wall Street, and those shiny objects can be alluring at times. So if we step forward, I just want to look at one thing to try and show people what we're talking about. Now, when you think about building a portfolio of the stocks and the bonds and the asset classes that Connor was walking us through, and you think about the compounding that Michaela was mentioning at the beginning, the opportunity oftentimes sits somewhere in the middle, meaning that when you're looking at this chart here, what it's showing is asset class performance through each of these calendar years. So 2007 through 2024. And you can see those references for things like FI, which is fixed income, the bond investments that Connor was talking about, the USLC, which is US large cap stocks. And oftentimes what you're going to notice here is that the leader from one year to the next is distinct. It's different. It's not always the same. And so when we're talking about that balance, that diversification, having portfolios that blend a couple of different asset classes that we walk through, the reason for doing that is that there's no guarantees as to what's going to happen in the future. And we've seen that in recent years. We've seen that in recent market environments, even just, over these last couple of weeks. There are no guarantees in the world of investing about what's going to happen in a future state. And so as you see, for instance, one year where fixed income might be your best asset class, and then that's followed by US stocks, that 60-40 line in the middle is telling you, well, if I blend those two things, so if I blend global stocks with a fixed income portfolio or a bond portfolio, where do I sit? And the idea here is that you bring those asset classes together because it allows you to participate when times are good, but it doesn't get you into trouble when times are bad. And there's always a lot more nuance to this conversation, but for the purposes of where we are today, this is a really important, powerful concept, because one of the things that is so fundamental to investing and starting along an investment journey is understanding your own behaviors, and understanding when you're going to react positively to how portfolios are performing, but also negatively. Some of the worst behaviors that people are prone to is selling when times are difficult, saying that, look, I'm fearful of where the markets are going, where the economy is headed. And so people will say, I just can't do this anymore. It's gotten to be too difficult. I need to pull my money out of the market and just go sit in those cash investments. That often happens at an inopportune moment. We've seen that in 2008. We've seen it at points in March of 2020. And so those behaviors are things that you really need to understand. And that's where these balanced and diversified portfolios become so powerful, because they allow you to navigate and manage through those behaviors. Now, to tie all of this together, let's think about what comes next. And this will address a few of the questions that we've received as well. Our first check box is done. Learning the core concepts. How do you define stocks? How do you define bonds? How do you think about that world of global assets that are available for us to invest our money? Then reflect on what your financial goals are. So we've heard today, we want to define investing as a long-term exercise, but realistically, not everyone's goals are measured over a decade period. Some people might be thinking about buying a home in the next 5 years. Others might be thinking about funding their retirement in 30 years. People might be thinking about the cost of college that could be coming in the next decade or the next 15 years. So you have to reflect on what those financial goals are. And the good news is we'll have a conversation later this summer about how you can do that and do it appropriately. So that'll be part of what comes next. The last part we want to mention here is stay curious. So I think the toughest thing for so many individuals is to just start investing. The world is a very complicated place. There are so many options at our disposal. It's very hard to just get started. And what we've told people in the past is once you start on this road, what you're going to find is that it becomes easier. So the first step is always the most difficult one, but it becomes easier. And so the ways that you can stay curious, the good news is that we have a whole world of podcasting out there. We have social media at our disposal. We have lots of market insights that are continuously available for people. So if you can appropriately synthesize and digest all of that information, there is a lot that you can read and learn and empower yourself with. Now, the last part before we open up for questions here is just tune in over the course of the summer. We'll have a conversation in July about budgeting essentials and how you can maintain your own financial freedom. Then we will get into our investment 201 discussion. So there have been questions around, well, how do I think about putting together stocks and bonds and what that looks like? how do I think about risk and return and reward? We're going to talk about that in the 201. So we really wanted to level set and get the base knowledge shared and distributed. And so we'll build on this conversation in late July. And then the last one is around thinking about family wealth conversations. We've had questions about donating and how do I think about charitable contributions? How do I tie that into my portfolio? That will be an important part of what we discuss in August. And so I would encourage people to tune in as well as they're thinking about charitable causes and donating money out of their investment portfolio. So with that, we'll close out for right now the prepared remarks. We do have quite a few questions, and so perhaps we can just start to go down the line and address them.
Thanks, Chris. Thanks, team. I think that helps set the foundation. And to your point, we're going to have a lot more and continue to build on this for the rest of the summer. But we did have a good amount of questions come in, and the Q&A box is open, so feel free to continuing to add questions to that chat box. If we don't get to your question right now, we will be following up with individuals directly after this call. I think an interesting place to start, and one thing we didn't touch on, is where stocks and bonds are traded. And so someone had asked about how are bonds actually offered for purchase. Are they traded on an exchange like stocks, such as the NYSE, or is the process different?
Yeah, I'll go ahead and answer that one. What I would encourage for a lot of people is you probably don't want to go out and trade individual bonds unless you're thinking about T-bills and something of that nature. You can log into your custodial account, so that might be with Charles Schwab or Fidelity or a similar custodian, and you could very easily go transact in an individual bond. But what I would suggest for a lot of people is, as we go through the 201 conversation, we're going to talk about different structural types. And why that's important is that in this day and age, you could invest in an exchange traded fund or a mutual fund. So outside that realm of individual bonds, there's an opportunity to utilize those products to your advantage. And we would suggest those are probably a bit more appropriate for most investors, unless you're just really truly thinking about treasury bills, treasury notes, and simple to transact securities like that. But yeah, we'll have that conversation in the 201.
Chris, this one might be getting a little bit deeper here, but you did show an earlier slide where you showed risk and return of investing in stocks. And we had a question come in to better understand how risk and the percentage of risk could be higher than the return you're getting. So can you just touch on more of an understanding on what risk you're talking about when it comes to equities?
Yep, I can take that one. So we were showing two different numbers. One was return and one was that standard deviation number that I was talking about. And so the average return is just your average over an extended period of time. But standard deviation is trying to measure how variable, what the range of outcomes looks like. And so it can be, that range can be positive or negative. So you're starting to get, you're trying to capture that median area where a certain percentage of outcomes might lie. And so it's just a statistical measure. It's not necessarily good or bad if it's higher or lower than the return itself, but the actual size of that number, or that volatility figure, standard deviation relative to other asset classes, is what we're looking at. So we would think about bonds in relation to stocks. Bonds are going to have a lower standard deviation relative to stocks because they're less volatile. We're starting to get into like statistics and some of the mathematical stuff, but that's the general concept there. There's nothing to read into in the number itself. It's more a relative assessment.
Another question that came in when talking about stocks and bonds, and this is also getting a little bit deeper here, and I think that what they're touching on is correlation. They said, can you re-explain the reverse returns of stocks and bonds? One goes up while the other seems to go down. So can you talk about the correlation between stocks and bonds?
Yeah, maybe I'll start there, and then Connor, if you want to add, please do. Michaela, if you want to add. Emily, same thing. So way to think about this is that when times are difficult and when stocks are going down a lot, people look for a safe haven asset. So people are going to sell the stocks until the dust settles. And when they do that, they tend to move into one of two places. That is either going to be cash. So they might take money that they've sold from those stock investments, move it into a bank account and say, all right, I can sleep safely at night because my money is now in a cash account and I feel all right. Or they may buy government bonds or core bonds. The reason that you do that is because you have that defined outcome that Connor was talking about. So a bond is a contractual obligation, assuming there is no default. And that contractual obligation in times of stress is very powerful because you know what your outcome is going to be over the coming years, over the coming months, whenever that bond is defined to mature. So what happens is that money will come out of the stock market and then money will go into pockets of the bond market, traditionally core bonds, high quality bonds, treasury bills, treasury notes, things that have a higher level of safety. And so that's why you have that negative correlation when stocks are really selling off, when the economy is doing poorly, when we might have a recession, bonds are doing better because of that rebalancing effect that takes place. That's the idea of the negative correlation. That does not happen in all environments. So, we would hopefully encourage people to remember past performance is no guarantee. That's one of our disclaimers that gets used very wide and far in this industry. And there's no guarantee that that's going to happen every single time that stocks sell off. But that historical relationship has been there a lot when people have needed it. And that's one of the philosophical beliefs that many investors have.
On philosophical beliefs, and I think something that a lot of people can relate to, we got a behavioral question that came in regarding how do you overcome the unpleasant feeling that you've waited too long to start investing. Michaela touched on the beginning, compounding interest and starting early. And they also added that, if you don't have enough time to catch up or that the economy is really uncertain right now. So finding that confidence to start investing, even if it is later.
Yeah, I can start with that one. I think from my perspective, obviously, as we talked about earlier, the better, but there is no better time to start than now. And just thinking about the compounding that you can start to embark on is the most important thing. Obviously, we can't control what our behavior was 5 years ago or what decisions we might have made. Maybe there was things in our life that just we decided to allocate our time to something else, and that's totally fair. So that there's no, I wouldn't be penalizing or beating myself up over it. It's more like let's focus on the opportunity in front of us. And with respect to the economy, yes, there's a lot of uncertainty right now. But I think if you were to go back in time at almost any point, you could find a whole number of reasons that people would be nervous about investing and the risks that are out there. That uncertainty is not new, and it's an inherent part of investing. But you have to remember that the reason that you're earning returns over time is because you're taking on risk. You don't earn return without risk. And so, the amount of return you should expect should be related to how much risk you're taking. But you should, we need to kind of focus on that reality and then think about the fact that over the long term, those things that we illustrated, you're very likely to earn money. Yes, maybe you're not going to find the top or you're not going to find the bottom. But if you think about compounding over time and you go to some of those charts that we showed, for example, I think there's been almost no instances of a 10-year horizon where a balanced portfolio didn't earn money. So,
Yeah.
if you keep that mindset and you understand I'm in this for the long term, or at least I'm intend to be disciplined, it'll work out.
Yeah, and if I could just add before we move to the next question, Connor said it best right there at the beginning, which is there's no time to invest like today. For people that might have said, all right, I've waited too long, my horizon isn't really long enough for me to be comfortable. Well, there really is no time like today. But the things you need to be careful of are trying to chase too much aggressive risk or trying to embrace a risk profile that might be beyond what you're comfortable with. So this is where conversations like this are really important. Have this conversation with a local investing club, or have this conversation with an advisor that you know, or someone that is in the industry, and try to work with them to understand, well, yes, maybe you have waited for a long time and it never quite feels like the right time to get into the market. And that's okay, but understand that there is no time like the present, and talk and engage with those people in your community that you're comfortable having this conversation with, so that you can begin to understand how much risk you should take so that you don't just get yourself into a difficult situation and make a bad situation into a worse one. Or now that you've waited too long, you're taking on more risk than what you should be doing. So that's where conversations and talking about money are really, really important. But I know a lot of people have a difficult time doing that.
One other question that came in is where did you go to take the first step in investing? Was it a person, a mentor, or a firm? And I think on that note, just giving guidance on people found this interesting, they want to learn more about investing. What should they do? Where should they go?
That's a great one. And, as I was mentioning there on that last slide, there are so many great podcasts right now. There are so many great books. Artificial intelligence, we haven't even gotten to the discussion around ChatGPT and Grok and all of these other AI engines that are available. What I would encourage people to do is start listening to podcasts. If you want to get really wonky and geeky, there's things like Odd Lots that are great. If you want to start simple, think about the Wall Street Journal podcast or NPR's Planet Money. There are books that have been written by authors like Morgan Housel, which I think everybody at our firm has read. So if we're all reading it, there must be something really powerful behind the messages that are being shared. I would encourage you to start there with the podcast, with the books. Morgan Housel has, in addition, a blog that he writes every week. We're constantly sharing articles and trying to talk to people in our network about the things that they're seeing, hearing, and reading. But taking that first step, we realize isn't easy. And, as much as we can be supportive, we are here to do that. And we want to be able to play that role. Connor, Michaela, did I miss anything else on those first steps?
I don't have anything to add. That's exactly what I would have said.
Yep. And hopefully the 201 will be supportive as well. And there's a lot of, for me, it was starting with things like Investopedia, right? I tell people that there's so many good sites out there that just help you with foundational knowledge, and start small. You don't have to watch CNBC or know all of the right terminology, right? Just get the foundations and then you'll start learning over time.
Yeah, and Emily, sorry not to interrupt you, but one other
Yeah.
idea that I know you and I have talked about is websites like Khan Academy.
Yes.
There are entire sessions that you can walk through and get as detailed as you want. So we try to keep this discussion high level, knowing that we have 1 hour and we don't want to bore people to sleep right before dinner time. But if you want to spend an entire day or an entire week going through the details of personal finance and budgeting and investing, Khan Academy is there, and there are other websites just like that we've used.
Yeah, universities have free investing and financing courses as well that we have folks who absolutely love and have found a lot of value in. But we can definitely follow up with more places to look. One of the other questions that I do want to touch on, because this is something we get a lot as an advisory firm and we touch on a lot as an investment team, is I heard you shouldn't get out of a downward market and then hop back in when the markets rise. Assuming the market ultimately drops 30%, and I think assuming is one of the key words there, why wouldn't I be better off if I got out at negative 10% and then return when the market starts to rebound at, let's say, negative 20%?
Yeah, if you could have the crystal ball that tells you exactly when those points are, then you don't need to be on this session and you'll probably be a billionaire pretty quickly. But the issue is that, right, nobody tells you, or there's no bell that's rung when the market's going to hit the bottom. There's no clear signals on when those things are going to take place, and you run the risk of, and you end up selling at the bottom, right? That's the concern, and now you're playing catch up for the rest of your investment horizon. So it's just exceptionally difficult to properly time those decisions, to the point where it's really no better chance than going to a casino. The key for us is to trust the long-term characteristics that we observe over the past 100+ years on how markets behave, and lean on that to our advantage. There are certainly traders that try to capture some of those things, and they might use some sophisticated approaches, but their success rate is probably far lower than you'd think. And it's got to be more about risk management in that context. So it's just exceedingly difficult to identify those points ahead of time. And the market is a forward-looking entity. It reflects the collective knowledge of all of the millions of people who are participating in that market. And the wisdom of the crowds is a very powerful thing. And it's unlikely that you're gonna, in isolation, be smarter than those millions of different people all at once.
The data is
in addition
interesting
to
as
that,
well, seeing how often the down markets fall within the top markets. So when markets are down, typically when markets are back up at their highest happens within a short period of time between that down market. So timing that and getting in and out as quickly as you would need to is very challenging. And that is one of the biggest reasons that people have a hard time timing the market when it comes to getting in and getting out at the right time. And unfortunately, to Connor's point, we see it too often when they get out of the market. And yes, maybe they did well for the first period in the first 10% down. It's understanding the right time to get back into the market and waiting too long and getting back in too late. And we saw that from a lot of people in 2020 and other periods of significant down markets.
Yeah, there was a question related to this, which we
Yeah.
haven't had time to touch on, which is the idea of taxation. I know somebody asked about tax treatment of different asset classes. That wasn't really something we could cover in this session, but the more you trade, the more you pay in taxes. And people really underestimate the impact of that over time, unless we're talking about retirement accounts and 401k accounts. The reality is, when we have seen accounts with lots of turnover, it has resulted in a lot of taxes being paid, and people don't often think about that.
And not to mention, it's during those periods where the market is falling that emotions are likely highest, and you are having to battle those emotional components of your decision making. And it's just a fact of human science that we are less likely to make the best decisions when we are battling those stressors. So it just adds another wrinkle into the equation of objectivity and how well you can navigate an environment like that if you're feeling some of those emotional stresses as well.
Well, I know we have a lot of other questions here, but we are at the top of the hour. So I do want to thank everyone again for joining today. For the questions that we did not get to, we're going to try going through those. And if we have your contact information, reaching out and providing that answer directly. We'll also be sending a follow-up email shortly after that includes the recording of today's session, as well as links to register for the upcoming sessions in the Financial Foundation series. You do have to register for each one of those individually. And if you're a client and want to go deeper on any of today's topics, please don't hesitate to reach out to your advisor. I know they would be happy to go into this in depth. And if you're not yet working with WellSpire and would like to connect with us, the follow-up email we send out will include a link to schedule a call or reach out directly to our team. So thank you so much again, and we look forward to seeing you at the next session in July. And thank you to the investment team for joining us today.